Hey guys, welcome back to our Phillip Trading Podcast. I'm your host for today. My name is Brian and I am a dealer here at Phillip Capital. Now, before we start, please take note that this presentation has not been reviewed by the Securities Commission Malaysia and is only for educational purposes only. It is not an invitation to buy or sell any products. Hence, the speakers, as well as PCSB, we are not liable for any financial decisions that you may make based on the contents of this presentation. Well, with us today is an extremely experienced speaker and trader, Mr. David. How are you today, David?
Sorry, I didn't unmute myself. Yeah, I'm good. Thanks, Brian, for the very kind invitation.
Okay, thank you, David. That's good to hear. Well, we also have another really special guest, which is Miss Susan Low of the Derivatives Product Development Team in Bursa, Malaysia. How are you, Susan?
Hi, Brian. Thanks for the introduction. It's good to be here.
Okay, thanks, Susan. That's great to hear. I'm fine too. So actually, Susan will be providing us some updates from Bursa before we get into the core content from David. So for now, I think I'll just pass the presentation to Susan so she can present on her slides. All right.
Thank you. Okay, today I will go through an introduction to the Bursa Malaysia DCE soybean oil futures. We call it FSOY. It was launched on 18 March 2024 this year, March. FSOY is a futures contract that is licensed from Dalian Commodity Exchange using the DCE soybean oil futures contract's final settlement price as a basis to calculate FSOY's final settlement price. So this is how it works, the little diagram here. DCE is the main contract where we license from, and it is denominated in CNY, Chinese yuan, and so its final settlement price is also in Chinese yuan. So how we do it is we using FSOY on the same day during their final settlement day, will take their final settlement price in CNY and calculate it, adjust it into US dollar to be FSOY's final settlement price. So technically, the price fluctuation of these two products, it should be similar, just one in CNY and one in USD. So here's an example of how to calculate it. DCE soybean oil September, the contract that has just expired on 13 September. Its final settlement price in CNY is 7,748. So what we do is we take this price and we check the CNY central parity rate on the same day, which is 7.1030, and we convert the CNY to USD, becomes 1090.81. As the FSOY, its minimum price fluctuation is 0.25, so we need to round it to the nearest 0.25, which is 1090.75. So this is exactly how it was calculated. So why we launch FSOY, and why is it a good opportunity for traders to trade with this product? First of all, DCE is the world's most actively traded crude soybean oil futures. They offer this product and it's very liquid. A lot of participants, international participants, is also participating DC's market for this product. And as for BMD, we launched the world's most actively traded crude palm oil futures. This is well known, as people take this as a benchmark to price the physical crude palm oil, as well as a well-recognized product by the market. And comparing palm oil and soybean oil as a standard business practices, these two commodities are substitutes in many applications. They are both able to do as a cooking oil, and so the price need to compete with each other as the users are quite similar. So having these two commodities in BMD allows traders to first capture arbitrage opportunity effectively, as these two commodity prices, they move in tandem, and enjoy margin credit from inter-commodity spreads trading. Meaning, before having the FSOY, people can only trade the soybean oil from different exchanges against BMD. But now, since FSoy is in BMD, there are margin credit available as both contracts are on same exchange. Third, pricing of FSoy will be the nearest to China's soybean pricing, and physical players exporting the soybean products to China can hedge price risk with FSoy as an alternative option for DCE soybean futures. So if you don't have an access to DCE, you can expose to Chinese soybean prices with BMD. Here's a diagram showing the related edible oils. FCPO, crude palm oil futures, the contract size is 25 metric ton per lot. FSoy, we make it 25 metric ton per lot as well. As for CM soybean oil futures, is 60,000 pounds, roughly 27.2 metric tons. As for DCE soybean oil, it's 10 metric tons per lot. So FSoy and DC soybean oil, although their contract size is different, but the way they price is also per metric ton. So the price is per metric ton per contract. Same as FCPO as well. Here's showing a price relationship of how the whole thing works. The red line here is the FCPO price quoted in US dollar per metric ton. CME soybean oil is blue, FSoy is green, and DC soybean oil is in this brown color. You can see that FSoy and DC soybean oil, the price move in tandem because they're the same product. We license it, the price should move in the same direction, almost closely as possible. There you see a little bit of difference because there's some difference in the way it's settled. Like DC, it is a VWAP of the whole day's trade. This one is using settlement price, so there's a little bit of difference. And this is the rate that is using a Bloomberg exchange rate. So sometimes the way different traders trade it, they might have a different perspective towards the US dollar CNY exchange rate. So there's a slight difference in settlement. Also, this FSoy settle using the last 1 hour VWAP only. So it's normal to have slight difference. The CME soybean oil, you can see that there are different fundamentals for the soybean oil in the US, so the price moves differently. And this one is also change adjusted to put in US dollar per metric ton instead of pounds. So there will be adjustment here. And CPO, you can see that the price movement of CPO is also closely related to how the soybean oil move. So this provides a good trading opportunity for traders to have a spread strategies between these products. Comes to performance bond margin requirement. FSoy's initial margin adopts the spend margin methodology like all the other BMD products. The initial margin for FSoy is currently at $900 US. Comparing with the FCPO is $7,000 US. For 900 US dollar, 7,000 ringgit, 900 US dollar. Compared to CPO, this is a really quite low margin product to trade for. So for traders, also it's a good opportunity. Compared to DCE soybean oil, DCE soybean oil is the margin, how the margin work is slightly different from us. They are using a percentage against the daily settlement value of the contract itself. So it is a 7%. Using some calculations to compare the margin, how to calculate FSoy, how many percentage it is compared to its value. Let's say the FSoy is currently priced around US dollar 1,100, making the total contract value, which is 25 metric tons, is 27,500 US dollar. So 27,500 US dollar contract value against the 900 US dollar margin is roughly 3% against the total value. So quite a good low margin product to trade. Here's a diagram of a difference between the F-Soy and the DC soybean oil futures. Although this is a licensed product, it comes with certain difference because it's adjusted so that it is convenient for traders to create spread strategy and hedge against CPO, FCPO. First of all, the most obvious difference is the contract size. F-Soy is designed to have 25 metric tons, same as the FCPO. It is different from DCE's contract, which is only 10 metric tons. Our minimum price fluctuation is 0.25 metric ton, also made to be similar to FCPO. 0.25 metric tons with the contract size, it makes one tick about $6.25, which is roughly comparable with a 25 ringgit compared to FCPO, whereas the DC is 2 yuan per metric ton. There are similarities. The contract is mostly similar when it comes to the design. Example, the contract months is exactly the same as DCE, where the most active month is usually January, May, and September. This is how the DC contract currently works, but their other contracts are quite liquid as well. It's just how the contract behaves currently. Trading hours, we have slightly longer trading hours compared to DC because we provide a opportunity to trade with FCPO when CPO market is open, but DC markets are really closed. Final trading day, we take the same day as DC's final trading day and settle with their final settlement price. And we are cash settled, they are physically settled. Our trading fee from the exchange is 90 US cents, 0.9 US dollar, compared to DC is 2.5 yuan. Take note that this is the exchange levy, so you have to take into account the brokerage from the broker as well. Yeah, this is all I have to share today. Pass back to you, Brian. Thank you for your time.
Okay, thank you, Susan. So for those who are interested in F-Soy, you can find more information on Bursa Malaysia's official website. Okay, so thank you, Susan. I will take over the presentation now.
Yep.
Okay.
Okay. Thanks, Brian and Susan. Okay, I'm just going to share my screen. Are you able to see my screen, Brian?
Yeah, we're able to see your screen now.
Yeah. Okay. So yeah, I think Susan has greatly highlighted on the new contract on F-Soy. I think it's clearly quite correlated with FCPO. So if you've been following the market in recent times, I think clearly the market is still trading at quite a tight range, but the daily volatility has actually increased quite tremendously. So as of yesterday, I think if you just take a snapshot of yesterday prices, price was trading at a high of close to 4,000 ringgit. But then I think towards the evening when we have the news that Indonesia may impose a lighter levy on export tax, on export levy, I think that greatly has influenced prices. In fact, I think prices went as low as almost touched the day low. That's a range of about 120 points on FCPO. That's great volatility. So if you are trading the market, it is indeed a very exciting times, especially to be in the palm oil market. Now, there's a lot of factors that contribute to this volatility, but as a trader, I think it's important for you to make sure that you have a proper risk management in place, which we're going to cover in a seminar on the 10th of October. So I think generally a preview on what we're going to talk about on that day. I think we just look at this chart, it's clearly you can see that CPO has actually been trading quite a tight range. Although we see daily fluctuation has that's increased in daily volatility, but overall, if you look at the longer term picture, CPO is trading at a very tight range between 4,000 to 3,700 ringgit per metric ton. And I believe that this range could sustain towards the year end. Now, I think my narrative is that the way I look at the market, there is a lot of bullish factors that may actually try to support prices as we head into the fourth quarter of the year. Reason being is because if you just look at one of the key supply and demand dynamics for palm oil market, supply is very seasonal in the palm oil space. If you just look at over the past 15 to 20 years of production data that is being published by MPOB on a monthly basis, it's very clear and it's quite evident that, as we head into August, rather September, October, or even in fact early November, that's where we start to see the peak in production. Now, whether history is history, history tends to repeat itself, but sometimes it doesn't. But you can take it as a good gauge as to where the market, or in terms of supply, is heading to. So we are heading to the fourth quarter of the year. Usually we expect palm oil production tend to be weaker. And once, if you just look at basic economics, low supply, high demand, that will really push prices higher. So I think this is one contributing factor in terms of fundamental factors that actually can drive CPO prices higher. Now, just to look at production in a better angle, this is a cumulative production, year-on-year basis. You can clearly see, I think this year so far, for the past 8 months, we have probably recorded close to 12 million tons of CPO production in Malaysia. Now, if you compare that to last year, it's a slight increase of about 10%. So we are 4 more months towards the end of 2024. So the key question is, are we able to see, or is it likely that 2024 production, CPO production in Malaysia, is it going to be higher? Now, the likelihood is going to be high because there's only 4 more months. If every subsequent months going forward recorded a positive number compared to year-on-year basis, we are likely to see this year production in Malaysia is going to be higher. Now, that may try to pressure prices. So therefore, I think prices are still trading at a very tight range. It's difficult for it to drive above 4,000 to sustain that level, given that this year likely you can see higher production compared to last year. Now, this is a factor that we really have to watch out. Now, if production next few months is quite bad, the numbers are below estimates, I think that's where we really could be a positive surprise for the market. So if you are trading the CPO market, is indeed a very interesting space to watch out in the next couple of months. Now, stocks again is an important consideration. If you look at important price factor consideration, you clearly can see the established relationship between a low stock environment. Normally, you expect prices tend to be stronger. Now, stocks are trading above. I think Malaysia stocks are trading well above the 2 million tons and staying quite comfortably around that level. Now, it's not to say it's very high stocks, and it's not to say it's very low stocks either. But I think as long as stocks continue to remain where it is, and probably there's a sign that it may go lower once production starts to taper off, likely it's going to be a factor that also can support prices. Now, demand, on the other hand, is quite a bullish year for this year for Malaysia CPO. You can clearly see that export pace has actually picked up quite considerably, especially in the second half of this year, mainly driven by India and China demand. Now, China story is a bit negative, given that they are still struggling with their own economy. But India, I think, is something of a positive offshoot. So I think the news yesterday that we have heard that Indonesia may reduce export levy as a way to try to gain back the market share is something of a short-term negative. But I think longer-term picture, if India's demand continue to be robust, keep in mind, normally you look at the chart, September to October period tend to see a slight pickup in exports. It's again very seasonal, because I think as India prepare for their Diwali season in October or November, usually they will stock up 2 months or 1 month before. So probably we'll see in the next couple of weeks a strong demand coming from India. But watch out. I think which I'm going to share more on the seminar later on, which is talking about highlighting how export levy can have an impact when it comes to demand. We can clearly see that yesterday, once Indonesia just announced the news that they will reduce the export levy, that actually dramatically changed the price direction for the CPO market. Now, I think I just want to put up this chart as well, and I think we should pay a bit more attention. So if you are trading on the FCPO space, it's also good to look at the FSOI space, because we can clearly see there's a strong relationship between crude palm oil and obviously the soybean oil market. Now, soybean oil market, we have both the US, and obviously right now with the new introduction of the FSOI contract, it clearly gives the traders a bit of leverage. Now, you can clearly see the discount and premium between both markets, the edible oil markets, palm oil and soybean oil. They used to have a very steep premium back in the early part of the onset of Ukraine conflict because of the grains price shock. But I think that has slowly tapered off. In fact, now I think we are trading at a discount. That means soybean oil looks relatively quite cheap. I think there's a lot of potential in that. Now, eventually, I think, the relationship between the US seaboard bean oil and the Malaysia CPO probably may have slight of a lesser correlation between both markets. But I think it's both to pay attention between the Malaysia CPO and the SY contract itself. So as what Susan highlighted earlier, spread strategies between both markets can present quite a bit of opportunity. So I think it's important to pay attention. I think really the bean oil market is actually been a very the fundamentals are very bearish, because you just look at South America and US. It's a record supply that's harvesting over there. So with record supply and demand, not much change. You're definitely going to see higher stocks going into 2025. So I think soybean oil is a very bearish sentiment, but I think it gives opportunity for traders to really capitalize on both markets. Now, I just want to touch a little bit, which I'm going to be focusing more on that day, which is talking about the biodiesel factor in relation to the crude oil prices and CPO. Now, biodiesel is an important element. If you have been trading the market, you notice that every time when there's a strong crude oil price, normally CPO price tend to be supported. Now, the key question is that you have seen over the past couple of weeks, oil price has actually been trading below the 70 mark, and is hovering around the 70 mark. So it's crucial. If oil prices couldn't sustain, I think that could cause a drag in terms of CPO prices because of the biodiesel factor. Now, there's a few developments on the biodiesel front, I think mainly coming from Indonesia, which is going to be a very important play going to 2025. So I'm just going to share a little bit more on that on that day. It's very important if you're trading a CPO market. One of the major considerations is look at the oil market as well, because it's usually, if oil market is bullish, generally expect the CPO market to be strong as well. Now, obviously, on that day, we're just going to share a bit more on the technical side. As we as a trader, we always find to pinpoint exact entry strategies and also exit strategies. Now, if you look at this technical chart that I posted here, you can clearly see that this is posted 2 days ago. Palm oil looks like palm oil prices still may have a bit of a leg on the upside, given that the bullish momentum is starting to pick up. So you look at the candles. We see more green candles in the subsequent days. These are all Heiken and She candles. More green candles in the subsequent days. It's quite clear to highlight that the market has a bit more upside rather than a downside. Now, keep in mind, the market is if you look at the longer term time frame, is still pretty much on a tight range. So during the webinar, I'm just going to share with you some of the strategies that we can use to really look at how can we navigate, especially when markets are trading on the longer time frame is trading at a range. So just to give some teaser on some of the areas that we're going to cover, I think firstly is that we have much talk about the supply and demand dynamics, which are important consideration when you look at CPO. So I think one of the major considerations also is to look at how the US or rather external factors like the US interest rates or even political developments affecting the CPO market. And I think much emphasis have to be put on soybean oil, which is quite crucial to the palm oil prices. And I think going into 2025, things may look slightly on the downward band, given I think mainly on the supply dynamics. I think if you just look at the numbers itself as we continue into 2025, looks like we might anticipate there's a bit more oversupply situation going into next year. Now, as a trader, fundamentals are crucial, but I think what's important is that we really need to identify ways or strategies that we can enter and exit the market efficiently. So I'm just going to share on that day some of the key technical trend trading strategies that you can use to ensure that you pinpoint and entry signals that whenever you look at chart reading. Now, last but not least, I think it's always important that when you have a trading plan in place, it is always good to incorporate stop loss management. I think that's very key because that will ensure your survival ultimately. So I think that's pretty much what I'm going to cover on that day. And hopefully, can see you guys on that day as well. So over to you, Brian.
Okay. Thank you, David. All right. So just let me pull this up. So that was such an insightful session from David, to view more on this topic. It's just a reminder that David will have a webinar with us on the 10th of October titled Technical Strategies and Market Outlook for FCPO in 2025. Thank you, David. So for those interested in trading Bursa Malaysia futures, Phillip Capital is currently running a promotion from the 1st of August this year to the 30th of October 2024 called Trade in Triumph BMD Edition, where you can stand a chance to win cash rewards up to 1,050 ringgit. Of course, T&Cs, they do apply. For more information, you can visit our website at phillip.com.my. So we've come to the end of our podcast. Thank you all for tuning in, but most importantly, thank you to David and Susan for your time. I'll see you guys in the next one. Bye-bye.
See you.
See you. Thank you.